Good day everyone and welcome back to our finance and media lesson 3 where we're going to continue where we left off. Please make sure that you've watched the previous recording to make sure that you actually get to grab the concept that we're going to be covering continuing forward. The lesson outcome even change. Under this lesson we're only going to cover what we call the general ledger and the trial balance as well with financial statements. So in terms of the general ledger, and we're going to do the trial balance, and then I'm going to explain the financial statements later on. So we did manage to cover the most important rules in terms of the double entry to say that for each transaction, you will have to identify, you have to understand what actually event took place. And then you also need to be able to identify the two accounts that are affected, classify the account whether it's an asset, expense, liability, income, or owner's equity or an owner's equity account. And then once you do that, therefore you classify whether this account is increasing. You do what we call the effect of the transaction to say is this account increasing or decreasing, and then you record the transaction within your general ledger, within your accounting equation, and make sure that it actually balance. But this time under the general ledger, we're going to be showing these effects within the general ledger rather than the accounting equation. But at the end of the day is that our books always need to balance. So we perform the following activity where we did mention where we get to learn the difference between the debit and the credit, as well as the effects that gets to be the effects of the positive or minus on each and every type of account that we've managed to classify. So just based on this accounting cycle, this is the following what actually took place in terms of the accounting cycle. So the first thing that we do is that we're going to analyze the transaction. Once you analyze the transaction, you're going to ask yourself all of those three questions that I've mentioned, including their sub question to say that what event took place, what are the accounts affected, where you get to identify the accounts affected. You get to also classify the accounts, whether this is an asset, income, liability, expense, or drawings account. Then once you identify those, you're going to also ask the question to say what is the effect on the accounting equation or on this account, and then later on, did my accounting equation actually balance? So all of this, while you are doing them, the last part where you have to ask did my accounting equation balance is when you prepare the journal entries and you record those informations. So when we prepare this under the journal entries, we are preparing them within the cash book, the cash payment book, and then once we are all done with all of these type of books, we therefore post all information to the post journal entry, which is our general ledger. So from the general ledger, each and every transaction will therefore have to be recorded within the general ledger, because in terms of the cash book and the cash payments, we only get to show information relating to the outflow and inflow of cash. But then in our general ledger, we're gonna be showing everything in detail to say that this is the amount we received, this is the amount we spent, this is the item that we returned, this is the item that were sold. So everything will be shown within the general ledger account. So if we're saying it's a bank account, everything that have to involve money going out and coming in the business will therefore, each and every transaction relating to that scenario will be posted or recorded within the general ledger. And then once it's there, at the end of the financial period, we're going to close off the general ledger by calculating the balances, and those balances will be transferred to what we call the trial balance. The first trial balance we prepare, it's called an unadjusted trial balance. Then what happens is that sometimes you find that the bank actually gets, or you get to perform reconciliation on your bank account on the 25th of each and every month, meaning that all transactions that occurred after the 25th will not therefore be recorded yet. So meaning that by the time you prepare your first trial balance, those transactions will not be reflected. So the first thing that we're going to do after you are done preparing your unadjusted trial balance is to make adjusted entries on our general ledger account that we close off, to say that these are additional information or transaction that took place between the 26th to the 31st. And once we have got those transactions, we're gonna record them back again to our trial balance and adjust our trial balance. So the trial balance that we're gonna prepare, we're gonna refer it as adjusted trial balance. And from there, we're gonna go and prepare what we call statement, financial statement, which is gonna be our statement of financial position and income statement. And if there are any other additional transaction that actually took place, maybe on the last day of the business, therefore we're going to prepare the closing entries. And once we prepare the closing entries for those transactions that took place on the last day when financial statement was prepared, and therefore we're going to prepare what we call a post closing trial balance from those. And then from post trial balance, we're going to prepare the final financial statements, and therefore the accounting cycle will be complete. And therefore the next coming financial period or next coming month, we prepare the same, we go under the same cycle. So here it is an information in terms of a general ledger. So a general ledger is referred to the T account that we normally always do, where we're going to have the debit and we're going to have the credit side. So this is what we call a general ledger account. So each and every account that we get to be classified, it also have its own general ledger account. If we say money was spent, bank account, so that's a general ledger account. So if we're saying that inventory was bought, inventory is an account, so it will be classified within the general ledger account, but under that classification of account, it will still fall within the assets. So here it says that the general ledger is a summary of all accounts of a business entity which are totaled and balanced off at the end of each month, meaning that for each and every account that we record or that we have, we're gonna record all transactions that are occurred or that are relevant to that particular account. If it's inventory coming in, the inventory account will have to reflect all transactions that have got inventory coming in and all transactions that have got inventory going out of the business. So all of this will be recorded within this account. And then it continued to say that a general ledger account is open for every item, whether it's an asset, liability, capital, drawing, income, or expense. And the purpose of the general ledger account are to determine the balance of all the balance sheet accounts and the totals of all the nominal sheet account. So here it's a cycle that gets to be followed. The transaction took place, you prepare an invoice and everything, so therefore the journal is recorded under your cash book, but then also therefore that information has to be posted to your general ledger account. And then from general ledger account, we're gonna calculate what we call the balances of each and every account and the totals, and all of these totals will be transferred to the trial balance, only the totals. And the trial balance, we're gonna prepare the income statement and a statement of financial position, which is our financial statements. So what are balance sheet and nominals? So the balance sheet accounts are all your assets, liability, capital, and drawings. So these accounts are balanced off by calculating the difference between the debit and the credit side of each account, and therefore we're gonna have what we call balance carried down and balance brought forward. So in terms of all of these accounts, if it's an asset, you're gonna have your plus this side and your minus this side, meaning that at the end of each and every month, you're gonna go and say all the amount that we received this month minus all the amount that we received, all the amount that you spent. So therefore, you're gonna get what we call balance carried down. So what actually happens is that each and every time when you prepare a balance sheet account under the general ledger, you calculate the total based on the side it increases by. So I'm gonna write another T account here, say minus and say plus. Okay, it's gonna be the same thing. I have to write a different story. So I'm just gonna clear this one. So we've got a plus, we've got a minus, and we've got a minus, and we've got a plus. So what I was saying is that when you total each and every account within the balance sheet account, each and every account will be totaled on the side it increased by. Reason behind that, we always use the logical or the explanation to say that you cannot spend more than what you actually have. You can only spend what you only have. Even meaning that if you don't have cash, you can go and borrow on credit, meaning that credit will be the minus side of your spending. So you're gonna have that account payable as your negative, showing that this is the people that you owe, or this is the amount that you owe. So under this activity here, or this explanation, is to go and say, if we are dealing with an assets account, all assets increase on the debit side, meaning that when you calculate the balances of this account, we're gonna go and say if it is a bank account, all money that we received, and we transfer the balance to the other side, and then we're gonna go and say all money that we received, which is this total balance here, minus all the money that we actually spent. So meaning that whatever is remaining will refer it as the balance carried down, or our balance. So the balance carried down is for that particular month, so it will be shown within that same account before the next coming one, or before the totals. So we normally show the balance carried down before the totals, which is gonna be before these total lines. So since it's a bank account and it decrease on the credit, so this will be recorded on the credit side to show that everything, make sure that it's balanced and it's equal to the same thing on the right side. So meaning that we're gonna say all the money that you spend plus the balance, which will be equal to all the money that you received. So if it was a liabilities account, we're gonna go and say that you bought the following things on credit, so your credit increased, this is how much you spend it, or this is how much you received as a credit. And then later on we're gonna calculate the total based on the credit that you received, and transfer it to the other side, and then come and say all the money that you paid back for people that you received credit from. So therefore we're gonna go and say all the amount of credit that you received minus all the one that you paid back. So this will give us what we call balance carried down under the liability account, which can be the trade payables. Therefore this will be written before the totals, and therefore the balance brought forward, which is the balance that we are taking from the previous month and bringing it to the next month. So meaning that it will be from balance carried forward to balance brought forward. Therefore we're gonna write it under the this side to say that this is the amount you owe. I'll make an example to say if you go and borrow 40k, or you bought assets for 40k on credit and only paid 20k, which is 20,000, 40,000, and then you went and paid 20,000. So therefore meaning that when you calculate your balance, your total will be all the total amount that you received on credit, which is 40,000, which is gonna have 40,000 here, 40,000 here, and then we're gonna go and say minus all the amount that you paid back, which is 20,000, meaning that you still owe 20,000. Meaning that when we start the month, the next following month, you're gonna start with a credit of 20,000 that you still get to owe. So if you pay that back, meaning that therefore now your trade payable becomes zero. And then we're gonna have your nominal account. So your nominal account are all your income and expenses. These accounts are not balanced off, however they are totaled for a specific financial period, because they only represent one financial year and will then be closed off. So here we've got income and we've got the expenses. So income, we know that they increase on the credit side and decrease on the debit, and this one they increase on the debit side and increase on the credit. So when you record information under these accounts, the nominal accounts, you're gonna only record on one side on which the information actually get to occur most of the time. So if we're referring under the income account, we're saying that okay, we've got the sales account. Our sales are gonna increase on the credit side, and therefore all the balances will be based on the credit side, and then all expenses are gonna be recorded on the debit side, and of therefore we're gonna have the information on the total on the debit side. So normally what actually happens is that with your nominal accounts and your expense account, we always gonna have information being recorded on only the side that it increased by. It's very rare for them to have information on the other side that it decreases by. But only things such as sales, that's when you can have sales return, where you're gonna also record it on the debit side, so that sales went down, there are goods that were returned of this value. Then you calculate the total of the sales account to say that this is my new total of my sales account, so that this is the amount that I sold, these are the goods that I sold, and these are the goods that were returned, so the total sales account is this much. And that account, which is called the sales return, you're also going to create an account for that, and it's going to be treated as an expense so far, to say that it reduces the what, the income that you generate from sales. So this is how the T account always looks like. So it's always in a T form. So you're gonna have your debit, you're gonna have your credit, and then you're gonna have the year and the month in which the transaction occurred. You're gonna have the day, and then you're gonna have the account and the amount. So I made an example to say that if this was a bank account and you get to receive money from the owner, and it's gonna be increasing, meaning that under the bank account you're gonna go on the debit side and say on this month of this whole year, under this specific date, capital from uh, Hurisani, you're gonna say H, or you're just gonna write in full, say Hurisani, which shows that this capital is coming from Hurisani if he's not the only account holder within the business. Even though it's the only person who owns the business, you're gonna still write that this is Hurisani, and then you're gonna write the amount received within your bank account. Once you spend money and go and buy inventory under the bank account, you can write on this month, year, and then day, we bought inventory worth this much, so money went out from our bank account. So, and then at the end we're going to calculate the balance that we actually went and spent on the we're going to calculate the balance of all the money that we received minus all the money that we spent, and therefore that remaining balance will be transferred to the following month. So this is an example of a balance sheet account, which they give an example based on the bank account, to say that on January 2023, the following transaction occurred. On the 3rd, the owner deposited capital of 20,000. And then the second transaction that occurred during this month is on the 7th, where the owner bought equipment for the business of 10,000 using the money of the business. And then we're gonna go and move forward. On the 11th, the owner went, and somewhere in between the 7th and the 11th, the owner went and bought something on credit. So that account or that transaction won't be recorded within the bank account, but will be recorded within the creditor's account and the other account that was affected by that transaction. And then once it's recorded, when we pay back the money, that's when our bank accounts gets to be affected. So here it's showing that on the 11th, we went and paid the creditors, that whoever that we bought things from on credit, and we paid on the 11th 5,000. So money is going out on our bank account. So on that creditor's account, since it increased on the credit side, on the debit side of that account, we're gonna go and write we actually paid this person this much, so that the amount can reduce the balance on the right side, which is the credit side of that creditor's account. And then on the 20th, the owner paid salaries of 1,000. So money is going out, so therefore we're gonna show on the bank side that we're paying salaries. We paid salaries of 1,000. And on the 22nd, the owner went and bought inventory for 6,000. So under inventory on the debit side, we're gonna go and say under the inventory account on January 2023, on the 22nd, bank of is 6,000, meaning that that inventory that is recorded of 6,000 was bought for cash. So that's why we debited bank under the inventory account. But on the bank account, we're gonna credit the inventory account to show that the money went out, and it went out and bought inventory. And then on the 25th, the owner went and received or sold some inventory and generated profit of 10,000. So that 10,000 will be recorded within the what? The bank account, that on the 25th we made cash sales of 10,000 that we received in our bank account. And at the end of the financial period of the month, you're gonna go and calculate the total amount received, which is 30,000, and you're gonna transfer it this side. And then later on we're going to go and say the amount that I received minus all the money that I spent, which is 10,000 plus 5 15,000 plus 16,000 plus 6,000, that's 22,000, meaning that you spent 22,000 for the month of January. So therefore the balance will be, the balance carried down will be 8,000, which is before the totals, so that when you add everything on the credit side, it should be equaling to everything on the right side, so that your bank account balances. So meaning that with the all money that you receive minus all the money that you spend, you are left with 8,000. So meaning that when we start the month of February on the 1st, 2023, the head's already written, so we don't have to repeat it here. Then we're just gonna come and say balance brought forward from the previous month, it's 8,000. So we're starting the month of February with a balance of 8,000. So if this was at the end of the financial period, what was going to happen is that this amount that is sitting here was going to be transferred to our trial balance, and from trial balance was going to be transferred to our statement of financial position under assets, to say under the bank we have got a balance of 8,000. Remember earlier on in the beginning of our lesson I did mention that the income, the statement of financial position, it's a summary of all balances within our accounting equation. And then if it is a nominal account, all nominal account, like I mentioned, we only record information on the side they increase by, and therefore only write the total at the end. So we have got your 2023 January. On 2023 January, we actually made sales on the 23rd. For on credit, we sold something to customer on credit, so we're gonna come and write account receivable plus the customer name to show that this is the customer and he actually bought on credit for 25,000, meaning that on the other side, on this account receivable, we're gonna come and say this is the amount. Okay, this guy actually bought on credit, this account receivable for Mang, or to say that this is the person that actually gets to sell, we sold these goods on credit to this customer. And then on this customer account, we're gonna go, since it's an asset, we're gonna say on the 23 January, on the 23rd, write sales to say that he actually bought something, and he will write 25,000 to show that he bought goods worth 25,000 on credit. So when this customer pays us back, we're gonna write it on this side so that this can subtract this, and then we have a zero effects on this account. But if it doesn't pay us all the amount, we're gonna have a balance that we'll start the next month with. And then on the 25th, remember we made a sales of 10,000, so therefore we're gonna go and write that on the 25th we made sales, which was cash. The money went to our bank account for 10,000. So therefore when we start February, if the financial year haven't yet ended, then we're gonna be continuing with the sales of 60,000 until the financial year end. So at the end of the financial year, if this was the end of the financial period, so therefore this sales of, okay, this is a bit incorrect. So it's supposed to say 25 plus this was supposed to be 35. So here we're supposed to have sales of 35. So this was going to be actually to be our sales of 35,000. So this sales of 35,000 is going to be transferred to the trial balance, and then from trial balance to our statement of financial position. So what is a trial balance? So a trial balance contains a summary of all the balance of the balance sheet accounts and the totals of all the nominal sheets account. So a trial balance is usually prepared on a monthly basis, but it can be prepared at any time when needed. And the purpose of a trial balance is to ensure that the double entry principle has been correctly applied. And for every debit, there will be a credit and vice versa. So on the trial balance, the process still remains the same, that we do our sales document, which is our invoice. Customer comes and buy, we prepare and record that information in our journals, which is our cash receipt and our cash payment. and then also post that information on our general ledger account, which we're gonna close at the end of the month or at the end of the period. Once we have got those balances within the general ledger, we therefore transfer the balances to the trial balance. And from trial balance, we prepare the income statement using these amounts. So the general ledger, this is how the general ledger looks like. So you're gonna be having your general ledger where you're gonna have your credit and debit. So your credit and debit will be showing all the amounts that you actually get where the balance is sitting. So with all your assets, all your assets and expenses as well as your drawings account, they all increase on the debit side and their balance will always be on the debit side. So therefore, all your amount will be recorded on the debit side within the trial balance. And all your income expenses, they increase on the credit side and their balances, normally the balance brought forward, are always on the credit side. So therefore, all of this will be recorded on the credit side, which is the side they increase by. And then we can try the following example. So this is an example which says that all company transactions occurred in March 2021. So on the first, Ryan deposited 50,000 in the business account as his capital contribution. So meaning that we're gonna have to identify the two accounts that are affected, which is going to be our bank account and the capital account for Ryan. So on our bank account, we classify this as an asset, the capital account of Ryan as an owner's equity. And therefore, when it comes to the effects, the bank account is increasing and the capital account is increasing. So therefore, we're gonna go and debit the bank account because it's growing. So on the T form or on the ledger account, we're gonna go to the debit side and go and say under the bank, we received capital, which is on the March, on 2021 March. Then we write the date to say first, and we write under the bank account that is capital contribution, and we also write the name that is Ryan, and then we write the amount that he contributed, that is 50,000. And then under the capital account, we're gonna go and say it's increasing, it increased on the credit side. So we're gonna write 2021 March on the first. We've got bank, which is increasing by 50,000 that Ryan deposited. And then on the 7th, it went and said paid weekly wages. So we have to identify the two accounts affected. We've got salaries and wages. And since it says paid, meaning that our bank account is affected, we paid the money back, we paid our employees. So meaning that under this transaction, what is actually going to happen is that we're going to go to the bank account. It's going to be decreasing. So on our bank account, we're going to go on the credit side since it's decreasing. And then we're going to go and say on the 7th, the date is already written March in 2021, which is the year. And then we're gonna go and say on the 7th, salaries and wages were paid, and this is the price. And therefore, we're gonna go into salaries and wages account, which is gonna be the T4. This is classified as an expense, so therefore expense increase on this side, which is the debit side. So we're gonna go on the debit side and write on the 2021 March on the 7th, bank money was used coming from the bank account to pay the salaries and wages of 1,500, and we're gonna write it here. And then we're gonna move forward to on the 14th, where it says sold goods to customer for cash 20,000 and cost price is 16,000. So here we've got four transactions, we've got four accounts affected, but only two accounts have got the main effect on the statement of on our accounting equation, which is the first transaction relating to the sales of the goods. So it says that sells goods to customer for cash 20,000. So on our bank account we are receiving 20,000. So we're gonna go to the debit and debit sales and therefore write 20,000. And then on our sales account we're gonna go to the credit side since it's increasing. and go and say that we've got on this date 2021 March, we've got on the 14th, we've got bank of 20,000, meaning that we saw our sales went up by cash sales of 20,000. And then the second two account remaining are what we call supporting accounts under this kind of transaction. They don't have much impact in terms of your accounting equation. They're just to make sure that the accounts represent the inflow, or we have to account for the outflow and inflow of cash within those accounts. So this one will affect what we call your cost of sales account and your what we call inventory. So when you bought inventory and it's sitting within your business, we just refer that as an inventory. And once you sell that inventory, the cost that you incur to buy that inventory becomes the cost of you generating the sales. So we refer it as cost of sales. So that account will be classified as cost of sales. So under inventory, inventory increases on the debit and decreases on the credit is an asset. So meaning that since our inventory will be decreasing because we sold some, we're gonna go on the credit side of the inventory account on the right 2021 March on the 14th. We're gonna write cost of sales to show that we sold the inventory that was sitting on the debit side. We sold it for, which was worth 16,000 was sold. And then we're gonna go and open another expense account called the cost of sales. Since this account is just increasing because sales was made, therefore we're gonna go to the debit side and write 2021 March. On the 14th, we've got inventory, which is now turned to cost of sales of 16,000. And then in terms of the purchased inventory for cash 35,000 from Easy Snitch. So when we purchase inventory, so meaning that on our inventory account, our inventory will be going up because now more stock is coming in. So, and when we classify the inventory, we say it's an asset. So assets increase by the debit side, which is the left side. So we're gonna go and record that on 2021 March. On the 25th, we're gonna write bank and we're gonna write 35,000 to say that we bought this inventory from cash, which is on our bank account, for 35,000. If it was on credit, we're gonna write the creditor's name there and then write 35,000. And we're gonna go to the creditor's account and then reflect this on the credit side that we received this on credit. And then since it says bought for cash, we're gonna go to our bank account and the credit side which the bank decreased by, and go and say that this is on this date, since the month and year have been written on this date, we spend it. We're gonna write inventory and write 35,000 to say that we spend 35,000 on inventory. So this is how it actually looks like in terms of the bank account. So we've got on the 1st of March the owner depositing capital in the bank account, and we go to the capital account and go and write on the 1st of March we received money was went to the bank account of 50,000. This is from the owner, so we're gonna call it R for Ryan. And then on the 7th, wages was paid, so we're gonna go and write 2021 7 wages paid 1.5, and we're gonna go to the wages salaries and wages account, which is an expense increasing on the debit side, and go and say 2021 March. On the 25th, the bank is decreasing. We spent 1,500, so meaning that on our salaries and wages we paid 1,500, and this was paid through the bank account which our money was going out. And then we're gonna move forward to second transaction, which is the sales, which happened on the 14th. So we're gonna write on 14th, since the date and month is already there, the year and month is already there, and says on our bank account we received 20,000, and this account is from sales account. And we're gonna go to the sales account and say on 2021 March, on the 14th, we sold goods worth 20,000, and this was sold for cash, which went to our bank account. And then we're gonna move to the part of the inventory. So the inventory for this sales was 16,000. So we're gonna write 2021 under the inventory under March. On the 14th, the inventory of 16,000 was converted to was sold, so we are subtracting it from the other inventory on the debit side. So it was transferred to become what? Cost of sales. So we're gonna go and open the cost of sales account and say on the 21 March, on the 14th, uh, inventory of 16,000 was sold, and that becomes what we call cost of sales. And then we move to our last transaction to say that on the 25th of March we bought inventory. Our bank is gonna go down because we put it cash, so meaning that we're gonna go on our bank side and write the date that on the 25th we bought inventory worth 35,000, meaning our bank account is going down. And then we're gonna go to our inventory account and say that on March 2021, on the 25th, so yes, 25th, so ignore this, and say that we actually went and bought inventory of 35,000, and this was bought cash. So we reflect that cash, that it was bought cash. And that is our last transaction. Therefore, what is left for us is to make sure that all balance sheet accounts are balanced and all nominal sheets account are totaled. So under this case, we're going to start with a bank account. So all the money that we received, the capital, the sales, so equaling to 70,000. So this will be our total, and this total will be transferred also to the credit side. And therefore, from there, we're gonna go and say all the money that we received, which is 70,000, minus all the money that we spent, how much are we left with in our bank account? So therefore, we're gonna have 70,000 minus 35 minus 1,500, giving us 33,500 as our balance carried down, to say that for this month the balance that is carried down, that is remaining, is 33,500. When we add it together with all the money that is spent, it's equaling to the money that we already received. And then from there we're going to transfer this balance to the debit side. Since the bank increase on the debit side, it's a positive bank balance. So therefore we're going to go and say on the 1st of April, the balance that will be brought forward under the year of 2021 will be 33,500. And then under the capital side, which is also falls within the balance sheet accounts, we're gonna go and say all the money that we received from Ryan is this much. This is the total, and then we put the total this side. Since there won't be money going out, we're just gonna go and write balance carry down of the same amount within the capital account. But if Ryan decides to change ownership and give the company to someone after selling it, we're gonna come to this account of Ryan and put and say write the new write the word capital this side and put the new name owner, and therefore this will cancel the amount of money that Ryan actually have in his account and become zero. And then we're gonna open a new capital account where the new owner will be credited with the balance that Ryan have. And anything that Ryan actually sold, this, if he actually sold this for 70,000, on the bank side, there's no effect, only that the 50,000 have to be transferred to the new owner, which means that here we're going to have the new owner's name, which will cancel the balance on the right. So therefore, the total will be 50-50, and there won't be no balance brought forward or carried down, which is going to be zero. So these accounts will be cancelled, and the new owner's account will therefore be credited with the balance of 50,000, and the 20,000 that Ryan makes is his own profit that SARS is going to tax him on the selling of share of the business. So I was just explaining in terms where the change of ownership actually gets to happen. And then we're going to have the sales account. Since the sales account is a nominal account, we just only write the total. So how many sales did we make this month? It was totaling to 20,000. So therefore, the balance of that month's sales will be transferred to the next month if the financial period have not yet ended. So if the financial period ended on March and the total balance is 20,000, so I mean this 20,000 will be transferred to the statement, which is the trial balance, and from trial balance to our statement of financial position. Same applies. Cost of sales is a nominal account, we write only the balance. Inventory is an assets account, so it's a balance sheet account, so therefore it have to be balanced off, to say that all the inventory stock we received of 35,000 Therefore, we'll calculate the total, which is 35,000, 35,000. And we went and say all the inventory that we actually sold minus all the inventory we sold. Therefore, we're going to have the balance carried on equaling to 19,000. So it means that we have got inventory remaining worth 19,000. Therefore, when we start the month of April, we're going to start it with a balance of 19,000, which is the balance brought forward. And salaries, it's an expense, so therefore we only calculate the total. So when we go prepare our trial balance, all this total that we calculated here will be transferred to the trial balance. As you can see from this side, so we're gonna have your balance sheet account. So you're gonna have the capital, which increase on the credit side, and its balance is on the credit side, so therefore it will be recorded under the credit side of the trial balance. And the bank account inventory, they are both assets, so therefore their balances will be written on the debit side. And then we move to the nominal accounts if there are no other balance sheet account, where we're going to say all nominal accounts. We've got all incomes, so all the incomes nominal account will be recorded on the credit side, and therefore the cost of sales will be recorded on the all the expenses will be recorded on the debit side. And we need to make sure that at the end your trial balance have to balance, so everything on the debit should be equal on the credit side to show that this is the effects from the accounting equation, everything gets to balance. And then there is an activity on your textbook explaining on page 37 example 1h to show that okay, they have already prepared what we call the trial balance, and then now there are transactions that occurred maybe after the 25th, and they have to be reconciled or included within your trial balance. So what actually happens is that when those transactions took place, we're gonna go and record those transactions again within the same account, which is the capital account or whichever account that actually occurred to, and then we're gonna transfer this amount to our trial balance and show those effects. And then once we show those effects, we're gonna have what we call an adjusted trial balance. So this is an adjusted trial balance. So normally if you are not going to prepare the general ledger account, what can happen is that here you have got a capital account of 100,000, and on your textbook it says that the owner deposited an additional contribution of 20,000. So what you can do to prepare a neutral balance, you can go or an adjusted, you can come here this side, open up and say 100,000 was received before, plus the new capital that the owner put it as an additional, which is 20,000. So therefore the new will be 120,000. So this plus here will already indicate that our capital account is increasing by 20,000. Same applies to our equipment. So here you can just come and write 40,000. This was the balance before the adjustment, plus the new equipment that was bought of 10,000. So therefore the total new equipment balance will be 50,000. So this plus is indicating that equipment was bought. If it was actually sold, we're gonna have a minus here to say that from 40,000 we subtract 20,000 of the equipment that was actually sold. And this will also be adjusted in our bank account. Say our bank account previously, we had a bank account of 5,000. We had a bank account of 5,000, so we're gonna come and say minus the amount of cash that we paid for that equipment, then plus any amount that we actually get to receive. So since we're receiving, we'll also receive 20,000 from the owner, we're gonna come and say plus 20,000, which was the first. We're gonna say plus, then minus the 10,000 that we spend on the new assets. So therefore this will give us a total of 12,500 based on the information that we received. So this is how you get to record your information within uh, your to make adjustment within the trial balance that is already generated, the unadjusted. From unadjusted, we're going to have the adjusted trial balance, and these are the effects within the T account that actually took place. So these are the effects within the T account, and therefore we're going to have your post trial balance. And from your post trial balance, we're going to have then to prepare your what you call income statement, your statement of financial position. So when we prepare those, when you prepare statement of financial position, when you prepare that, you're going to have your column, one column, and you're going to start with your assets under the statement of financial position, and then you're going to write all the assets within your trial balance, and you're going to add them up, and you're going to have your total asset, and then you're going to come and have your equity. All your equity will be your capital minus your drawings, and therefore you're going to have your total equity. And then after that, you're going to have your liability. You're going to have your liability. All account related to liabilities, you're going to list them here, and then you're going to add all of them together. And then later on, you're going to come here and say equity plus liability. So your equity plus liability balance that is going to be placed here should be equaling to your total assets, so that it shows that your accounting equation actually get to balance. That also means that your statement of financial position will actually balance. So on your textbook on page 50, let me just quickly get that. On page 52, there is an example of a what we call statement of financial position, which will show all the account within the assets that were added together based on the category, whether this is a current asset or non-current assets. They were added together to give a total assets of 782,930 rands. And then we have got the owner's equity, where the owner's equity was showing the capital that the owner contributed, the net profit that the company generated, less the drawings to give us the total what owner's equity. And then we've got the we've got the liabilities, where we've got the non-current liabilities and current liabilities all added together. Once we've got the total for liabilities, we're gonna also go and say total for liabilities plus total for equities. Therefore, we're going to have total equity and liabilities of 78,782,130, which shows that both now our assets and accounting equation actually balance, meaning that when we were recording these transactions, all of them that occurred within the business, they all ended up balancing the accounting equation. And remember, the trial balance, so the statement of financial position, as I've mentioned earlier, it's a summary of your what? Accounting equation. So statement of financial position is a summary of an accounting equation which shows only the balance to show that everything went and balanced. And then on page 51, you have got your statement of comprehensive income, which is your income statement, which is made up from the trial balance as well. To gain, so you're going to take your sales minus your cost of sales. Therefore, it's going to give you what you call gross profit. And from gross profit, you're going to add all other incomes that we call, refer them as operating income, to get what we call gross operating income. And then after that, you're going to subtract all your expenses. Once you subtract all the expenses, you're going to get what we call operating profit. So the information on page 26, which is called classification of accounts, you need to understand them to make sure that you understand which accounts are expense, which accounts are income, and which accounts are assets, which accounts are liabilities and equities, so that when you prepare these statements, you are able to prepare them in a better at a right, using the right method. So if, for example, under your income statement, if you check information pertaining to this, start from page 47, which is from your general ledger account. So the information from your general ledger account was posted to your trial balance, and from trial balance, that information goes straight to your what statement of financial position and statement of income, financial performance, which is the income statement. So if you take a look under the sales, you will see that we've got sales, which is the first account under nominal, and we've got sales return. So the sales return, when you calculate the total sales for that particular period, it will be the total sales minus the sales return to give you 832,000. Or if you don't actually want to do that, you can take the sales and transfer it towards your operating expense, as it's an expense gonna be reducing the sales. So this is the two methods that you can actually get to use. But for your assessment, please understand the income statement that is on page 51. It's a straightforward. So you just only get to understand before the gross profit, it's only your sales and cost of sales. And after that, we've got other operating income. to give you what we call gross operating income. And then you less all your operating expenses, you'll have what we call operating profit. From operating profit, you subtract interest income, then you're going to have profit before interest expenses. So the interest expenses, so interest income that you are seeing below there, it's supposed to be added under what we call other operating income. So you can include it there instead of putting it down there because it's an other operating income. So you have to put it within other operating income. And then before operating profit, we're going to have what we call operating profit before interest and tax. And then you subtract interest first, then you have profit before tax, and then you subtract tax, then you have got your net profit. So if you have got any question relating to this, please make sure that you do send me an email and then I will be able to assist you. So in terms of everything that we just covered, so the example starts, I think, on page 42 in terms of recording financial transaction at year end, and then how they get to end up to financial statements. So financial statement are using balances under the end of the trial balance. So please try to calculate or do activity 1U to prepare financial statements, and then you'll see that this information is not that difficult because all the information within your trial balance just have to be transferred towards your income statement. Solution is at the end of the textbook. So that will be all for today. So meaning that we're gonna be starting with a new lesson next week on our week 3. So we're gonna be starting with a new lesson which is chapter 2. So please make sure that you look into this and practice. When you get stuck, let me know, and then from there we'll take it from there, and I will assist you as much as I can. And then please make sure that you do pre-reading of chapter 2, which is something that we already covered, so there won't be much new. Some of the things that are there, we already covered them. It's just a matter of now doing most of the practical questions and practicing and make sure that we get to perfect our mathematics skills. So that is it from my side. Please enjoy the rest of your day. We shall meet again next time.